Listen, I was telling you right before we started, this is the best Buffett book I've ever read. I was enchanted by the book. My wife actually read it. That's how much I liked it. She doesn't really read that much in terms of finance, but I was like, you got to read this. The stories are incredible. I want to get to all that. But first, I got to ask you, it's very rare that you read a financial book that's well written. The writing was enchanting. I didn't want to put it down. The storytelling was so great. Where did you learn to write?
So it's kind of a funny story is I was working on the book for a couple of years as I was employed as an analyst at a fund, and then the fund shut down, and I was like 30-40% of the way done with the book, and I was like, "I'm just gonna take a year and just do this." And I sent an early chapter of Disney to Bill Ackman, and I never met before, I didn't know him, and he calls me up, and we have, like, a 5-minute conversation. He's like, "You have a really interesting product here, but you need to work on the writing." So I was like, if Ackman thinks this is an interesting idea. I think that there's a lot more commercial potential than I initially thought. So I hired 2 writing coaches to help me, like, fix the structure, tell a story, that type of stuff, and I think my writing went from being very poor to, I think I'm okay now.
Man, it's world class. For everybody who's listening, this is just the best written finance book I've ever read. The stories it teaches, the lessons it teaches, the stories it tells are amazing, but it's actually the writing that really makes it extraordinary. You don't find many financial analysts that know how to write. So, really congratulations on all that. The second thing I've been dying to know is where did you find all this information? The amount of research that you have done is extraordinary. I've been a Buffett guy for 30 years. I didn't know about half of these stories. Where did you find all this stuff?
The book, The Snowball by Al Schroeder, kind of formed the foundation of the book where a lot of the early trades were found in there. Um, but then I kind of had to hunt for the corporate documents, the annual reports, like the proxies were applicable, that type of stuff. The first source was at the New York Public Library, where they had a lot of these old annual reports on microcard, microfiche. There's also this database that has a lot of them on PDF, which allowed.
So hold on, you went to a library?
Yes. And
Who would have ever thought of that?
not only that is that as I was like digging, I would buy books on um the companies and industries I wanted to study. For example, I'd want to study like the department store industry or the hardware wholesale industry. And in the footnotes, they'd reference archives at certain libraries. So I'd call them up, ask them to scan the documents. I'd pay a few $100s, and I just kept getting these documents sent to me, and I accumulated a kind of treasure trove that helped me write the book.
Man, it's incredible. It really is. The book actually really turns into a cool history of capitalism. You see Buffett really navigating the migration of the early industrial revolution to the modern economy. And one of my favorite stories in the book is the story of Reading, the Reading Coal and Train Company, and I also love the Studebaker story. These are, companies that are in the midst of this transition and in our economy, and watching Buffett deal with really cheap companies that were cheap because they had been the victims of a technological change, like the move away from anthracite coal as a heating source. Just all these examples are just timeless. And of course, he handled most of these things well. I'm working on a Buffett book myself, and I have to admit mine's not nearly as well written as yours. Maybe maybe I'll get the names of your writing coaches, but my book is called Warren's Mistakes, and everybody knows that Warren's a great investor, the best that ever lived. It's easy to laud his genius, and I do frequently. But what I also find so fascinating is to err is human, and even the world's greatest investor has made some really bonehead decisions. As you went through his early investments, um, where did you find he made the biggest mistake? By the way, either of omission or of commission.
Oh, so that's a great question. There's one company that I wanted to do more work on and write about it, but I actually just couldn't find one which company it was, and to the documents was he invested in this like Cuban sugar company in the 50s or 60s, and it was only zero in the partnership, but it was a very small position for him. But I think the company wound up going bankrupt. that was one mistake where I don't know all the details off the top of my head, but I think the Cuban government basically just, like, kinda intervened and, uh, stole property in a way.
In '59, it probably got appropriate
Yeah,
nationalized or whatever they called it.
that's what I think
Stolen.
happened, and, I think Buffett talked about this in a meeting once in a while. However, like, generally in the early years, like, really pre-partnership, his mistakes were investing in companies with poor capital allocation, where the stock just looked cheap and management just, like, sucked. Um, they would keep reinvesting in the business.
Berkshire Hathaway.
Yeah, the difference between Berkshire and the reason why I think like Philadelphia Writing such a great case study um, is a change in capital allocation. Like in Philadelphia Writing, Ben Graham and Mickey Newman were the ones to take over and transform the company. With Berkshire, it was Buffett. But if Buffett didn't intervene into Berkshire Hathaway, it would have kind of the same result as some of these
There would
early
have been a zero. Yep.
exactly. It would eventually went bankrupt, liquidated, all that stuff. So you really need to change the capital allocation. In terms of the case studies in the book, I would say the biggest mistake is Hochschild Kohn, the Baltimore retailer that they bought in 1966.
Yep.
They meaning Buffett, Charlie Munger, and Sandy Gottesman, where it looked like kind of cheap, but it had no moat. There's no competitive advantage. The Baltimore city center was declining. Uh,
Still is.
yeah, uh,
Yeah, let's a good tip from that story is when a family-owned and controlled business for 3 or 4 generations wants to sell, maybe they know more about it than you do.
yeah. And one of the things that was kind of interesting about the story is so Sandy Gottesman's mother-in-law owned some equity in the company, and one of the reasons why they were like saying they wanted to sell was because they had nobody to run the business. But Cohn family remained on as owners, so that didn't really add up either. Um, I don't know if they had a sense of what would happen to Baltimore. I mean, my view is the MLK riots of '68 actually kind of accelerated the decline, but it seemed like uh, they were selling to for financial reasons just as much as management.
Yeah, it's been a lousy business for a long time.
Yeah.
When you were writing the book, did the stories as you dove into them, did they have an impact on your own investing, like in your personal account? Did you begin to look at things differently, and if so, how?
Yeah, absolutely. So, impacted in two different ways. First, I became a lot more concentrated, meaning I remember as I was like writing the book, I'd probably have 15, 20 positions, and I kind of cut that in half. So it's 7, 8 positions instead of 15, 20. Second, there's this category of investments that Buffett invested in called workouts. The only one I write about in the book is called British Columbia Power,
Mhm.
but
This
workouts.
is an incredible story.
Thank you. Um,
Amazing.
they're essentially special situations. They're merger arbitrage, liquidations, that type of stuff. Uh, and I started investing much more heavily into those where the cash flows are predictable, but the timing isn't necessarily. Meaning, a company is going to liquidate, they're going to distribute, say, a dollar to shareholders, but you're not sure if it's going to be in 3 months or maybe a year or two.
Do
I
do
began,
you recall the acquisition? I'm not sure when you got into the financial markets, I might be dating myself here, but in the fall of '08, there was an all-cash offer made for Budweiser, and the deal closed in the 3rd week of November of 2008 in the midst of the global financial crisis. Were you in the markets at that time?
no, so I would have been entering my senior year of high school in 2008.
No.
Yeah.
Jeez. Anyways, that was the greatest workout I ever saw ever, and it wasn't nearly as good as the British Columbia Power, but there was a $70 all cash offer on the table for Budweiser. Stock was trading at $58 a share with 2 weeks until close. I've had about 150% of my personal net worth, pushed it all in. And I can't recall who it was on Wall Street, whether it was Icon or maybe Pershing Square, but some other people made like $100 million in that week on that merger arb deal. So yeah, those can be really extraordinary situations.
Yeah, and I think especially in like smaller cap land, there's actually more of these than people think. Small and nano cap land. I think a lot of the merger arb I think has gotten like broadly efficient in mid and large cap, but there's still like one offs like with like
I don't know. I made a lot of money on the Twitter merger arb, and I made a lot of money on the Microsoft Activision merger arb. And in my opinion, particularly the merger Microsoft Activision merger, I don't know why I can't say that rapidly 5 times. That one for me was there was just no downside. If the deal fell apart, Activision was still a great stock to own, and it was gonna get some kind of huge cash payout from Microsoft. So it seemed like a no-brainer to me. So I would agree with you that large cap merger arb that's attractive is more rare, but it's still, I mean, you can still do very well on that.
Yeah, and the other thing is you're not like necessarily buying companies that are like significantly overvalued, right? Like you're not buying some SaaS company that's trading at 1,000 times revenue, where the the valuation if the deal doesn't go through is like 50, 60, 70, 80, 90% lower. You're buying stocks whose might even be cheap if the company's at the price they're being acquired at, right? So that's another angle where you have like the downside protection, so you're able to find into the arb.
I got one last question for you. I really appreciate your time, Brett. I'm telling you, your books is the favorite finance book I've read in 20 years.
Thank
I
you.
can't praise you highly enough for the work that you've done. I've been a pretty severe critic of Berkshire Hathaway between 2009 and 2018. I I backed off a lot of that because of the Apple investment, which was just extraordinary. And now I'm a critic again, and let me explain why. Berkshire Hathaway was always the world's best insurance company, led by the world's best investor, investing in the world's highest quality, most capital efficient businesses. And all of a sudden, after 2009, they got completely away from that game plan. They started putting enormous amounts of capital into the energy business, which is highly regulated, and of course into the railroad, which is highly regulated. And then between 2009 and 2016, when I started buying Apple, virtually everything they bought was either a relatively poor business where they were protected by a preferred security, or worse, IBM. And it just seemed like they really got away from their knitting in terms of the quality of the businesses that they were willing to invest in, and I was critical of that. Of course, they put half the portfolio into Apple, and that's the greatest investment in the history of the public markets, so I stopped chirping so much. But now, they're over 30% of their book is in cash, and they've got another 30% of their book in the railroad and the energy stocks, or the energy business, Berkshire Hathaway Energy, and I don't see how they're gonna outperform the S&P when they have so much of their capital tied up in capital intensive, highly regulated businesses. And it's incredible to me that they've only taken one dividend from the entire history of the energy investments. One dividend. And they're now facing, a potential $40 billion liability from the wildfires. Like, this is a terrible business to be in. So my plan for Berkshire, which by the way, no one's asked me to join the board. I don't think they're reading any of my comments, but I don't understand why they do not spin off to their shareholders. The railroad is a separate entity. The power company is a separate entity. Let their shareholders decide if they want to be energy investors or railroad investors, and keep the property and casualty insurance and the portfolio business. If they did that, the valuation on that part of Berkshire would be worth more than all of Berkshire is today, because that's a super high margin, super high growth business, and the railroad and the energy is just dead money. So you're like, "What's your question?" Well, my question is, if you were in charge of Berkshire today, knowing all that you know about Buffett and all of his investing, and Buffett's retiring and you're now the CEO, chairman of Berkshire, what do you do about these problems? How do you handle Berkshire's incredible size and, frankly, the the marginal returns it's likely to earn on some of its largest holdings?
Yeah, first, I'm very glad Greg Abel has this problem and not me, because I think it's a very difficult position to be in, to be managing $1 trillion organization. I think the probability that Berkshire meaningfully outperforms over decades is not very high. I think that maybe they can do beat it by beat the S&P by 200-300 basis points, but it's very hard to have a number that you previously had. Uh, Mostly a function of size, just like there's not that many companies that they can go out and buy that move the needle. I think the businesses they have are good. I think the energy business is good, although the returns on invested capital aren't as good as, say Apple, but, as you pointed out. Um, I th I think the railroad's very good. I still think the insurance businesses, even if Ajit Jain steps down, will be good. So they have a really good collection of assets. It's just the fact that the company's just so big, it's almost it's extraordinarily difficult to outperform. My view is that I think that when Buffett is passes and is no longer chairman, um, they will institute a dividend as well as a larger repurchase program to bring some of that give some of that cash back to shareholders. I don't think that they're going to spin off assets, partially because I think the way a lot of these entities are structured is if the insurance company might hold an asset that in theory might the insurance company might entirely own an asset that in theory would be spun off. And I think that unwinding that would be too difficult.
Yeah.
So I'd be surprised if there's a breakup of Berkshire, but I do think that there will be dividends. I do think there will be repurchases. Um, I think from what I've heard about Greg Abel, he's great. But there's only one Warren Buffett, and even Buffett's had a difficult time allocating capital over the past 10, 15 years just because they're so big and there's so few opportunities that can move the needle.
I said that was the last question, but I lied. There's one more. What's your opinion about the likelihood of success for Bill Ackman and his plan to turn Howard Hughes into a Berkshire-like permanent capital vehicle?
So I'm very bullish on Bill Ackman. I actually don't know all the details of the Howard Hughes investment, um, but I would bet on him. Um, I think it's a really interesting idea. I think Ackman's right that you need a permanent capital vehicle to um, manage capital over the long term, and he's already done that in different ways where he has like the closed-end fund trading in I think it's Amsterdam. Um, but that's not as efficient of a vehicle as he needs to be for a bunch of reasons. So I really like the ambitions to do it under Howard Hughes. Especially, I've never done work on it to be clear. But
Okay. So I'm here to do some more work on.
it seems like he thinks it's cheap, so it's kind of a good. He's stepping into a asset that's he thinks is undervalued, and then he can reallocate the capital the way he sees best. So I'm bullish.
Well, great. Well, thank you so much for your time today, Brett. It was great to meet you, and I thought your book was extraordinary. Are you going to write another book?
Not anytime soon.
Well, listen, I hope the sales are great. I'll keep pumping it up for you, and I'd love to get together with you in New York at some point.
Yeah, same here. Thank you. Thanks for having me, and yeah, I'd love to meet you in person as well.
Porter, high accolades when you say it is the best Buffett book you've ever read. Literally.
Yeah, for sure. It for sure is the best book about Buffett. I would also tell you, I think it's top 3 all-time best books I've ever read about finance or investing in general.
There's a reason why the world's best informed investors read my daily journal. Subscribe for free at portersjournal.com.